Welcome to the Retirement Income Source with Tim Sparks. Our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. This show is for you, the listener. We're committed to you if you are a pre-retiree considering retiring and want to make sure you get it right. Or if you're a retiree and you want your retirement to end well. All I can say is be diligent. You are on your own. Get informed, and most importantly, learn how your money works. That's the drum I've been beating on this show for the last 4+ years. And what you thought was true in accumulating wealth may not be the same whenever you transition into retirement. In other words, accumulation works very well because you're contributing each and every year or each and every paycheck. And to me, that's really the easy part. The hard part is knowing how to maintain your principal while at the same time simultaneously taking income out, the income that you desire and you need to do the things that you want to do. And so we appreciate you listening in today on our show. And we're going to be talking about what is your prescription. That is right. We probably heard it when we go into the doctor's office. But believe it or not, we all need a prescription, and we're going to have one. And to me, a prescription is supposed to be something like a solution. But beware that although we have a past and we have a present, the problem is it's the future that's unknown. And don't assume that the future will be the same as the past. That's the problem. Understand that building wealth is much easier than keeping wealth while simultaneously generating the income you need from your retirement accounts and your other savings vehicles. The question is how much income will you get? And most importantly, can you preserve it at the same time? You know, anytime you ask any financial advisor to preserve and get me the income I'm looking for, or hopefully it's in a range of 4 to 5% of your account balance, which is typically what most people utilize, that's a real tall order. Why is that? Because you are just probably like me, you probably want to make sure your balance is maintained. That's a marriage made in heaven. We don't want our balances to decrease. We don't want to see them go down. And what if I told you, unfortunately, majority of the people that are listening to this show are already on the road where it's going to be very difficult to recover because you are spending principal each and every paycheck that's coming to you from your 401ks or your IRAs when you're taking those withdrawals. Because at the end of the day, we can call income a withdrawal of our money. Anybody can. You can put it in a CD and call it a withdrawal, and it's considered income. But when I say income, I'm talking about something that is paid to you regardless of what the markets do, especially if you're going to be in the markets. You see, the reason I like investing for income is because income is something that's paid to me for the instruments that I'm hold, like this, like individual stocks that pay dividends or even bonds or bond-like instruments. I want to just live on the income that they pay. You can do that, and only that, it's more of a longer-term strategy versus a short-term strategy, kind of like, at least for now, CDs are paying fairly generously. Or even money markets, as most of you know. And right now, cash has become sort of a commodity. Well, stay tuned. That's not going to last a real long time, especially when these rates turn back around. I was talking to our analysts just a day or two ago. These are the guys that are in the trenches. They're the ones that sees what the markets are going on the inside, what they're doing. This is, Wall Street, right there in the mix of it. And they got all the tools and they got the training, they got the experience behind them. And they see things that a lot of times are not even talked about in the media. Matter of fact, it's neglected in the media because, people turn on the, business news or what have you, or even financial news, and they think that that information that they're getting is gospel. It's always, somewhat partially true, but a lot of the information gets left out is very important because, most of us want to win, and we want to win when the markets give us that opportunity. And the other times we want to be protected when when there is no opportunity available. And I'm talking about growth. Growth comes and goes. It's like the hare versus the tortoise. Sometimes you win, sometimes you lose. The problem is too many people are dependent on that type of instrument to get them through retirement. Imagine the word sometimes. Sometimes you get income, sometimes you don't. And what I mean by that right there is this. We all look at our bottom line. We look at what we've actually made here recently or in the last year. And so it makes us feel good and we feel comfortable to go ahead and spend our money. But I hate to tell you this, you're having to give up principal to do that. What I have figured every time we do an analysis for a client, every time they just take out $10, I'm just talking about let's just dummy this down and make it simple. Every time they take out $10, $7 of it is their own money. And I don't know about you, but that's a recipe for possibly running out of money. No wonder people are so concerned today about running out of money before they run out of breath. And if you would, go back and listen to some of our other shows where I talk about total return and what makes up the component. There's two components that makes a return. There's a reliable side of the return. That's the I, the interest and dividend. And then, of course, there's the unreliable side. And that's exactly what people are focusing on when they are in retirement. They're focusing on something that's unreliable. And I call that if-come versus income. But did you know that there's dangers whenever you're spending your principal, especially at that level? $7 out of $10 is your own money returned back to you. And to me, that doesn't sit well with me. It may be okay with you because maybe you're not noticing that. But it's one of the things that goes unnoticed when in one's portfolio. But there's a commission report out there that talks about the dangers of spending that money. We call it reverse dollar cost averaging, or one of the biggest enemies is spending your principal. And when you spend your principal early on, which is when people are more likely going to spend more of their money, they're going to be spending principal. And when they spend principal, they don't know what's going to happen. It doesn't matter how much you saved. The question is how much are you keeping? And so there's a commission report I like to get in your hand called the 7 Risks to Your Retirement. And it goes into 7 different problems that could affect your retirement. And you can get that commission report by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail it to you or even email it, whichever you prefer. That number again is 888-930-1080. It's a very helpful piece and it brings to light. And the reason these little commission report so important because most of us, we kind of like want to read something and hopefully it grabs our attention. Well, when it comes to our money, if there's anything no more important than your money, I don't know what it is, especially when it goes into retirement. Because if you want to have a lavish lifestyle in retirement, you want to be able to understand how your money works. You're listening to the Retirement Income Source. I'm Tim Sparks, and we're talking today, what will be your prescription? What will you choose? We all want cures when we get sick. We wind up at the doctor's office. And so typically they prescribe a medication to us. We go get it. And within a few weeks, or hopefully less than that, we're back to normal. Also, there's other things that comes up, like a water leak that could come up in our crawl space or in our basement, or like me, I had some shower leaks that could have damaged some foundation to our house, and it happened more than twice. We immediately stop what we're doing to get those things fixed. Well, you see, when it comes to our money, the problem goes unnoticed, sometimes sooner or eventually later. Sometimes it can come at a cost. You see, a cost that forces you to make a fire sale decision. Now, what do I mean by fire sale decision? I've seen people where they were forced to sell their home because the debt was overbearing. They lost their job and they were forced to sell their home. And typically when you sell your home, you usually don't get the value of your home that you want to. So you wind up settling for less than what it's really worth. Most of us want to, buy low and of course sell high. And a fire sale decision, it's just kind of my little method of what I call, it's trying to sell it quickly. And sometimes you may see signs in the yard where, you may see, not an estate sale, an absolute auction. And so in other words, those people are going to wind up selling that. And usually they wind up settling sometimes for 70 to 75 cents on the dollar. So you wind up giving up. So you make some fire sale decisions, and fire sale decisions is not a good time to make decisions. That's the reason why I like to invest for income. I don't have to worry about making that decision so quickly when things are not going the way you had planned. Because you can still invest for income, get the income regardless of what the markets in of itself are doing. Keep in mind, when you buy a share of Coca-Cola stock, for example, there's a certain amount of dollar value that's going to be paid to you because you own that share. Now, the share price is what fluctuates. So in other words, and I'm just giving an arbitrary number, if it's at $10 a share on that Coca-Cola, and let's just say you're getting $1 because you own that, because that's how you get dividends, it's paid on a per share basis, the $10 may drop to $8. Well, that means the value of the share went down 20%. And does that ring a bell? That kind of reminds you of 2022. Well, did you know if you're invested for income, the dollar doesn't change just because because the value of the share drops. You see, that's the reason I like investing for income. Why? Because it's paid to you regardless of the market performance. In other words, sometimes you win, sometimes you lose. Well, we're coming up on a break, and I'm going to let you know about an excellent book called The Retirement Income Story. It's one of my favorite books that I like to offer here on the show, and it's authored by CFA. That's a certified financial analyst. This is the upper echelon in our industry, kind of the in the trenches at Wall Street, so to speak, and it's written by Dave Scranton. And we talk a lot about the concepts that we're talking about here on the show today. Matter of fact, easy to understand concepts that you should be reading about, especially if you're going into retirement. And I got a free copy for the first 5 callers of today's Retirement Income Source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail it out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks. We'll be right back. Welcome to the Retirement Income Source with Tim Sparks. I'm your host today, and our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. Our firm specializes in working with people going into retirement, and you may think, when do you actually take on a client? A lot of times it really just depends. It depends on the age. I mean, we have a client right now that hired us at age 54 and decided to retire at age 54. And how can they do that at 54, especially if they got large qualified plans and there's penalties involved? Well, there's ways of doing that. And, but that could be, depends on, what assets you have. Sometimes people have 401ks that they're sitting on from past employers, and they may want those type of plans to be managed for investing for income, and they're not 59 and a half. Or even brokerage accounts. Sometimes we get calls from people that are trying to do things on their own and realize that maybe they need to explore the avenue of dividends. It really just depends. But for a pre-retiree, it is highly suggested at least 5 years before you retire. And the biggest reason why is because you want to be able to make sure that you hit your target date. And if you, and nobody knows this, remember, we're talking about the future. If the markets have a tendency to go the direction that you don't want them to go, in other words, they go south, then you're going to postpone your retirement plans. You know, at the end of the day, when some people want to hit their target, if it's age 65, then you want to start looking at investing for income at age 60. Or if it's age 70, for example, and you're 65 now, whatever it is, you want to be able to hit your target date perfectly. And you can do that when you invest for income. Why is that? Because you're locking in your income and when you get started. Because interest and dividends are paid to you regardless of the market performance. And so even if the markets have a tendency to go down, a lot of people don't realize that income is paid regardless at the time you start. So if you had $1 million today and you came in, this is a great example, and you need, or let's just say that I can get 40, 45, or maybe $50,000 in true income, interest and dividends paid to you, and you did that for the next 5 years, that's another, $250,000 more that's going to be reinvested back into that account, because dividends is a return, and it's a minimum return. It's unlike right now where you're at, if you look at the math from 50,000 on the high side to 40,000 on the low side on the dividend, on the what we do for our clients, and then you look at what you're getting in your mutual funds right now, 10 to 20,000. That's a significant difference, and that can make such a huge impact. But keep in mind that income continues to grow at 4 to 5% a year. So, and why? Because it's reinvested. When it reinvests, it buys more income. So imagine, let's just say that the market's dropped 4 or 5 years in a row. Did you know that that's good news when you're an income investor? Why? Because your income is going to continue to increase. And you may think, well, how is that? Well, think about it. Just like right now, bonds have taken a big hit. And so has a lot of your income instruments. That's because rates have went up, and they've stayed up for the last several years. And right now, rates, are on bonds and stuff are the highest I've seen in many years. And so, when do you get into those bond and bond-like instruments? It's now. You don't wait till the market gets back to normal and rates come back down. You've already missed the opportunity on a conservative instruments where you can have your cake and eat it too. Because when it's down, the value comes back up. And so it's kind of like getting a gain from the value side because it's discounted right now. And also the income at the same time. And not only that, the income's higher now than it would be to wait until the income gets lower. So you got those instruments working for you right now. So when you go into retirement in 5 years, you'll hit your target. So if you have $1 million, that $1 million in 5 years could easily turn into, let's just say, 60,000+ a year. So if that's enough income, and keep in mind, that's not a strategy. I'm not being strategic here. That just to kind of give you the concept and help you to understand how income, continues to grow regardless of what the balances do in of itself. And whenever the balances get discounted, that actually benefits you. So you want to be able to invest in that way, so that way you can hit your target. When you hit your target, now and not only that, what if the markets go up and you're invested in stocks? Well, you get your cake and eat it too. You don't have to worry about that fear that everybody has of missing out on the growth opportunity as well. And we do that a lot. So it's, in a nutshell, it's always important to start as early as possible, at least a minimum of 5 years, maybe sometimes even longer if you want to hit that target date. Because income compounds your returns, because that means you're buying more and more shares because your dollar cost averaging. And did you know most people right now, if when they're setting aside money in their 401ks, they're at the max? Well, the maximum contribution is what, $28,000. And, on $1 million, if you had an additional $40,000 or $50,000 coming in, what do you think it's going to do to your portfolio? It's going to put it on steroids. It's going to be a position that you want to be in because you're trying to prepare for the days ahead. Well, there's a risk report that I'd like to get in your hands. In order to do that, it starts with a phone call with myself, or even a Zoom meeting, or a lot of people just want to come to our office located right here in Lexington, Kentucky. And we can actually answer that question and prepare you for the day, for that time, if it's 4 years from now or 5 years or what have you. We have people come in all the time that are not retiring and they're over 59 and a half, and they want to be able to put their money in position to where they can hit their target date. And this retirement risk report, which covers, it's more of a multifaceted type of financial plan, but its good news is it's only one single page and it's much easier to understand. It's proprietary, and we use this to be able to help people to know the distinction of what they're giving up versus what they're getting right now. I don't know about you. I don't like the idea of giving up new money if I knew I can get it each and every year. And that's what this retirement risk report will help you get. And so if you call 888-930-1080, you want to schedule that appointment with myself. You will talk to one of the ladies here in our office and they can get that scheduled for you. And so, yes, there will be some information we will need in order to be able to provide this retirement risk report. And the good news is it will allow you to determine whether you're on the right path. And again, that number is 888-930-1080. And you're going to learn about a formula that you may have known or may have heard of it in the past called total return equals I plus G. In other words, you are already utilizing this tool right now, but the magic of this formula is the I. The I is what makes all the difference. The I is where you get the most mileage out of your money. It's not the G. And when you transition in retirement, it needs to be the most important component, the one that you need to utilize and understand. It's not the G. And also, we have this retirement risk report, Will You Outlive Your Money? We have a commission report too that you can also request if you're not interested in getting a risk report right out of the gate, but would like to maybe in the coming months, and gives you more and more time to be able to explore on your own. I mean, if you're like me, I like to take time, and I don't want people to bother me about my decision process, but there's a lot of things that goes into play here, and the question is, or what you want to do is you want to arm yourself so that way you're prepared whenever you get ready to go into retirement, and you want to make the absolute best decision. We all do. And if you would prefer to get a commission report on the retirement risk report and understanding what this report entails, we got several pages to offer you and great information about what that means. And it's multifaceted type report. It covers taxes. It covers what type of instruments you're using. Are they contractual or non-contractual, and so forth. And I think it would be a great read. But we're coming up on the break, and I'm going to let you know about an excellent book called The Retirement Income Story, authored by CFA, Certified Financial Analyst Dave Scranton. And he talks about investing for income. In other words, not income like every retirement planner talks about, where they're spending your principal and calling it a plan. Although the word plan sounds good, you see, whenever you invest for interest and dividends and it's coming from actual income, then you don't have to worry about what market history is going to do, because nobody can control the growth side of the equation. It's always the income side that you should be focusing on the most. And this report elaborates on that, the tools that you should be using whenever you transition into retirement. And another question I would ask is, why isn't my advisor making these recommendations today, and what makes us different? And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail it out to you if you're one of the first 5 callers, free, no obligation book. My number again is 888-930-1080. When we come back, we're going to answer a few questions. And like, if I invest for income, does that mean I will not get total return? Will I miss out on the growth? And sometimes I think people want that question answered, and the question is emphatically no. And we'll cover more of that here in a few minutes. You're listening to the Retirement Income Source with Tim Sparks. I'll be right back. You're tuned in to the Retirement Income Source with Tim Sparks. Our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. This show is always about the importance of income investing. Thanks for listening. Today we're talking about, what is your prescription? We all want a remedy. What remedy am I talking about? I'm talking about a remedy to get you through retirement. We all want to land well. And the thing is, we're all going to settle for a solution. The question is, which one is the right solution? Speaking of that, I was reading somewhere where, don't know, there's a lot of truth to it, but it makes a lot of sense. When people turn about 63, 65 on average, when they go into retirement, they will typically change advisors at least 3 to 5 times by the time they reach age 80. Now think about what I just said there. They'll change 3 to 5 times. In other words, if they change advisors, that means that something is not working out. And so if I don't know about you, I have tried everything. I have been on the side trying to convince people that total return was the way to go. Now I'm an anti-total return guy. I'm now more focusing on the I, which is part of the total return, and not as much on the G, because if I get the I, I'll get the G. But if I focus on the G, I will not always get the I. That's the difference. And the G is growth. That's capital appreciation. The I, the interest and dividends are paid to me for whatever it is that I own. If I own individual stocks, I'm going to get dividends. If I own individual bonds, I'm going to get interest paid to me, just like I would if I had a CD. So that's the solution that I like. It's just me. We all are going to, drink some kind of a Kool-Aid for retirement planning. And to me, that gets the most mileage. I've tried it all and it does not work. This one right here makes our clients feel more at ease. They finally understand their money for a change. But see, what everybody's wanting to run from is the most commonly used plan today. It's the one that where everybody's relying on total return. It's called a withdrawal plan. And you've heard of them. All you got to do is put one on the spreadsheet or put one in a software, and it will give you a nice little withdrawal plan and forecast the future of, let's just say, for the next 30 years. You've probably seen those, and then all of a sudden, voila, your retirement is fixed just because the software said so. But this plan relies too much on market history and past performance. The word past has nothing to do with the future. And so that's the reason why they'll use things like cash flow rule of 4%. The rule was there to be able to keep advisors from suggesting, any advisor, including myself, from suggesting too big of a withdrawal rate, because the client is actually going to probably more likely run out of money even sooner. 4% means the money will more likely last 25 years. And there's no promises there. Actually, it's been changed. My Morningstar, it's actually been reduced to more like 3.5%. So people, what they're doing is they're engineering their income. They're taking withdrawals and calling it income, and unfortunately, they're actually withdrawing their principal. And believe it or not, they're withdrawing $7 from every time they take out $10. They're withdrawing $7 of their own principal. Now think about that for a moment. You have your principal. It's $1 million 401k, $1.5 million, 500,000, 3 million, whatever the number is. Question is how much income are you going to get for that amount of money? If you put it in a CD, it's pretty simple. You know, at least the next 12 months, you're going to get maybe a 3.5% to 4.5% return. But when you put it in the market, unlike a CD, you can get a return longer than that, and a lot of times as much or if not more than that. And so retirement income planning is about trying to take care of the marathon of your retirement. In other words, looking down the road at the same time. Because people will tell me, how long do I need my money to last? Well, that depends on how long you think you're going to live. And if that's the case, your income needs to continue to pay to you. And why not, this is a novel idea, increase the interest in the dividends. Because that part of the plan will get you the most mileage out of your money. But keep in mind that interest in dividends is nothing new. I read an article that came out about a year or two ago, and it was talking about Warren Buffett. I'm sure most of us know who Warren Buffett is. And the title of the article says this: here's how much dividend income Warren Buffett will receive in 2021. And they were going down to how much money he was going to receive just in income, folks. And the markets fluctuated, right? They're always going to fluctuate. But it goes on to say that dividend stocks are the silent heroes that propelled Warren Buffett's wealth creation for decades. Now think about that for a moment. Is he on to something? Are we talking about income in vain here? No, this is nothing new. Insurance companies do this. They do that to sustain long-term portfolios. And they have to do it with corporate bonds and U.S. Treasuries. So you see, dividend and investing for income, there's something to that, especially when you look at the longevity of corporations. Corporations in of itself, whenever they have their own cash, in other words, their excess cash, their reserves, so to speak, and the insurance companies included, most importantly, the insurance companies, is they invest in income instruments. Why? Because there's volatility. And so since there's volatility in the market, they need something they can count on. And only that, they've understood that income is much more reliable than it would be if you are trying to focus on growth. And not only that, what are the oldest institutions in the world? If you think about it for a moment, it's insurance companies and these large corporations, and they're in business since 1912, in business since 1927. I'm just making up some arbitrary dates here, but the thing is, though, what makes that? I mean, it's how they invest their money. And here you are with the opportunity to be able to invest your money for income to get more mileage and do the things that these people do. You got here by accumulating wealth, but what's going to get you there depends on how you invest your money. So if you would like to know more about that, there's a commission report I want to get in your hand called Passive Income for Retirement. Passive income is used by landlords when they collect rent. You can also do that with individual stocks and individual bonds and other bond-like instruments. This commission report can be yours. You will learn more about this by calling 888-930-1080. Again, that's 888-930-1080, and we'll mail this out to your email at whichever you prefer. Again, that number is 888-930-1080. Great commission report on passive income. You're listening to the Retirement Income Source. I'm Tim Sparks, and we're talking about what is your prescription? What is going to be your cure? We all want a cure. But not only that, we want a cure for the long haul. You don't just dream about what your retirement's going to look like. You need to be intentional. Intentional means you need to focus on how and the why. In other words, why do investments, and what makes them tick? In other words, Do you want a reliable return coming in each and every month that's going to satisfy that income, or do you want an unreliable return? You'll be surprised. The people who are listening are, believe it or not, are focusing more on the unreliable return to get them through retirement. Well, there's a question out there that I've had, and I thought I would share this with you. And it's this: if I invest for income, does that mean I will get less total return? There's people out there that have actually came in our office a year later or so after their portfolios have finally came back to normal after they took a while from that loss that they suffered in 2022, and they're ready to invest for income. And I told them, I said, it doesn't really matter when you start, but start. Why is that? And so if you invest for income, a lot of times people think they're sacrificing growth. That's not true. Now, if you bought bonds and bond-like instruments, that's very possible. Yes, people want to be more conservative in retirement or even getting close to retirement. The last thing you want to do is to see your balance go down beyond what you believe was too much of a loss. So in other words, you got to have that discussion. I always talk about a dollar amount. If a client says, I don't want to lose no more than 20%, I said, okay, 20% on $1 million, $200,000. If your balance drops $800,000, are you okay with that? And even sometimes they'll even say, I'm more like 10%. So I put a dollar amount to that whenever you're having this discussion. But you got to keep in mind that you can invest in stocks the growth way, or you can invest in stocks the income way. You can also invest in bonds the growth way, which is what a lot of people do, or you can do it the income way. Well, if you think about it for a moment, income is the thing you're trying to solve in retirement. So that means that if you get the income up high enough, that means you don't have to touch your principal. Imagine not touching your principal for 10 years, just at least 10 years. Well, you're 65, now you're 75. How many years you got left, but yet you still got your principal? Well, that's the conservative way of what I'm talking about, just more like a bond and bond-like instruments, more like contractual instruments. But if you invested in, more like stocks where you got the potential growth and you can live on the dividend, and the dividend is adequate enough to sustain your lifestyle for that 10 years, hey, if the markets go up, your balance is going to go up not because it was structured that way, because nobody knows the future growth of any instrument, but you know what the income is going to be. Because see, the dividend is paid to you regardless of whether the markets go up or whether they go down. So you got to keep in mind that you can invest in stocks the growth way or the income way. We prefer the income way. It's kind of like killing two birds with one stone. So just do the math here for a moment. Last year, the markets went up 20%. 25%, depends on how you were invested. Question is how much dividend did you get? Do you know, every time I ask that question, nobody really knows how much they actually got paid to them. Well, when you go into retirement, you need to understand what that number is if you're wanting to preserve. And keep in mind, preservation, the key to preservation is how you will spend your money and how much will be coming from principal. You want to minimize that. In other words, you want to reduce the amount of your spending in principal and increase the amount you're getting in income. So I'm going to take a guess. If you had a 20% cumulative return, and I'm just saying, assuming you're looking at your statement at the end of the year, kind of like some of us do, we bottom line our investments. Of that 20, you probably got about 1.5% in dividends. That's it. That's all you got. The rest of it came from capital appreciation. But values go up on homes and everything else, but the only way you can sell an increase in value or get income from it, you have to sell it, correct? Well, you see, that doesn't even make sense, because a lot of times we don't want to sell because things are going very well. But here's the thing. If you're taking that monthly income, you're selling and don't even realize it. So if you think about it for a moment, if you got a 6% return, 4 of it came from dividends and 2 of it came from growth, you still made 6%. But if the markets goes up 6% in the way that you're investing now, you only got 1 or 1.5% from the dividends. So in other words, your growth had to work harder, not lesser, like it did from the other alternative scenario, the one I talked about earlier. Making 4 means I got less I have to make in growth. So there is advantages. And keep in mind, people, that there's a lot of academic studies out there that actually show. Matter of fact, I read a great book last year on an actual, no hypothetical portfolio advisor or firm that's been managing money for over 60 years and still in existence today. 20 plus billion under management, and all they focus on is the same thing that Warren Buffett does, and that is really big fans of investing for dividends. Now keep in mind, Warren Buffett can probably have growth too because he can afford it. But what catapulted his wealth was the dividend portfolio. And academic studies have proven that over time, value outperforms growth. Why? Because you're buying more shares every year because you got more dividends coming in, where growth has very little dividends, if any at all. So you're focused on wholeheartedly on the growth side. In other words, you've seen that commercial on television. Wait for it. And that's what growth is. When it comes to dividends, you don't have to wait for it. It's going to pay to you quarterly. And it equates to, and at least in our clients' portfolio, about a gross 4.5%. But if you would like to learn more, a little bit more in depth about that, I got an excellent book called A Retirement Income Story authored by CFA, that's Certified Financial Analyst Dave Scranton. Talks about investing for income and why your advisor is not making these recommendations. People, your statement is their recommendation. If call it what it is. Call a spade what it is. If you like the idea of investing for income, or you don't understand the value of investing for income, now's the time to find it out. Great book, great read, and I got a free copy for the first 5 callers of today's Retirement Income Source by calling 888-930-1080. Again, that's 888-930-1080, and we'll mail this book out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You're listening to the Retirement Income Source with Tim Sparks. We'll be right back. Welcome to the Retirement Income Source. I'm Tim Sparks, and we're talking about what is your prescription for retirement. What prescription will you choose? What solution will you take through retirement? But you have to be able to, you need to answer that in a way that you understand how your money works. I bring that up a lot because, I don't like to talk about something or boast about something and not unless I know a lot about it. Seeing is believing. I see that. I see the grins on our clients' faces whenever they're going to the bank account each and every month, and they're really taking it from the interest and dividends and how their portfolios are being maintained even through this really tipsy-turvy time. And so it's definitely an eye-opener for our firm. And to be honest with you, when you're working with people and working with their life savings, the last thing you want to do is, have an egg on your face because you gave the wrong advice. Because sometimes people may like you if you're a financial advisor, they like the way you smile, or, the way you dress, or like the way the firm you work for, or whatever. But at the end of the day, I want people to like me because we did what we said we would do. And investing for income, people, makes a profound difference on your portfolio as far as getting the most mileage. This is not some kind of a joke coming up or anything like that. When it comes to your money, matter of fact, all jokes aside, just like my dad said, I've got very few friends. I mean, in other words, I'm watching my money constantly. And like I said earlier, I said, if somebody is 63, 65, with a study I seen here recently, they said that they will fire their financial advisor when they go into retirement and change financial advisors 3 to 5 times on average within 15 years. That's pretty significant. And some of it could be a lot of reasons. But One thing that I do know is every time the markets go down, people get worried because they don't know. They don't know how their money works. And so when people become a client here, we have what we call our rookie year service. So with our rookie year, we basically spend more and more time helping them to see what they actually did. And I didn't want them to think that they took a blind faith leap into a program that does not work. They actually will. I know they're going to own it. It's going to be in their bloodstream by the time we get to the fourth or the fifth visit. And with that being said, I'm going to get a retirement risk report in your hands. It's a commission report. It's a great read. And it talks about, will you outlive your money? You know, that's a big question. Everybody's wanting to know, will they outlive their money? People are taking or having second thoughts about retirement. We run across it a lot of times and they don't know what to do. And so there is no absolute solution because, you know, we have these these investments that we think are going to happen and so forth. We would like to have the 80s and the 90s back, which will be a great recipe for a great retirement, but you don't know if that's going to happen. You don't know if you're going to get 2013, where you're not going to get any returns for 13 years, or you're going to get a bullish market. And so you have to be prepared for both. So I like to get this commission report in your hands, the retirement risk report. Will you outlive your money? Call 888-930-1080. Again, that's 888-930-1080. We'll mail it or email it, whichever you prefer. Again, that number is 888-930-1080. You're listening to the Retirement Income Source. I'm Tim Sparks, and I'm your host, and we're talking about what is your prescription. What is your prescription? It should be a question you should ask. You know, it's just my way of saying, what is your retirement plan going to be? What retirement plan will you choose to get you through the next 20, 25, or 30 years or more, ever how long you're going to live? And people are concerned about that because, you know, a lot of things can happen in that time frame. And when you're on your own and you're in retirement, it's kind of like being self-employed. You know, you're really going to be focusing on your money and how it works. Not that money is everything, but it's nice to know that you know, your money is doing what you hope it to do. So the question is, what will you do? What would you do if you had a 2000 to 2013 era? Imagine that. You're 65. You was to experience something like that. By the way, we have actually run across clients that's actually been through that never, ever want to see that again. I wish I could just have them here on the radio show and just sitting here giving the warnings out, you know, like a tornado, the tornado siren, so to speak, in maybe an area where there's frequent tornadoes. But imagine what they would be saying. Not that you have to be completely risk averse and go completely to the extreme on the other side and have a retirement that you didn't even envision and maybe even one you dread. We're talking about being in a position where you can have growth and income, but focusing on income first, not focusing on income last, which is what most people actually do in retirement. And they're doing it right now. And they don't even know they're actually doing it. Because, you know, if you think about 2000, 2013, that's 12, almost 13 zeros. No growth with it whatsoever. And you had to go through that. So you're now age 78. And now the market's finally rebound. I mean, that's how you got that's how you got to think about it. You know, nobody talks about, you know, worst case scenario. And even if they did, if you're still in the market or if you're focusing on total return, that is not a solution. You're not focusing on income. You're hoping to get income, but you're going to have to take withdrawals to go through those periods. And I'm going to be honest with you. If you know what the balances would look like by taking just a simple 4%, you would avoid it like a plague. And matter of fact, we'll look for ways to be able to get through those troubling periods because they're going to happen. What is your plan B? Well, we're coming up on the end of our show, and I would like to be able to talk a lot more about this because there's a lot to talk about when it comes to prescription. It's just kind of my little, I always think of what I'm going to talk about each show. Just to give a different spin on things when it comes the importance of investing for income while in retirement. But I got an excellent book I like to get in your hand called The Retirement Income Story, authored by CFA, Certified Financial Analyst Dave Scranton. Does a great job of explaining the income instruments out there, the bond and bond-like instruments that people don't even take a notice of when it comes to retirement, but yet they're trying to solve income in retirement. I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this book out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You have been listening to the Retirement Income Source with Tim Sparks, and today we've been talking about what is your prescription, what is your antidote for retirement. You're going to choose one, but choose wisely. We thank you for listening to the show, and we hope you've learned a lot from this show, and we hope it was beneficial. We look forward to next week for some more great information for our loyal listeners. Thank you for listening.